A lumber CEO in Kentucky just warned that the supply capacity to meet the next housing rebound doesn't exist anymore. The prices that follow will be unlike anything the construction market has ever seen. Check this out, watch it, and learn how to prepare for what is coming.
Lumber seriously downgraded their demand forecast, and this will cause a huge ripple effect. In January, Forest Economic Advisors, the most cited lumber demand forecasting firm in North America, projected housing starts would grow 8.6% in 2026, 1.5 million units. Softwood consumption up 8.4%. The housing recovery was on its way. In March, they published the update, barely announced it. Starts revised down to 1.36 million. Growth revised to 1.5%. Consumption growth revised to 0.2%. The recovery didn't arrive. It got pushed to 2027 at the earliest. That revision from 8.6% to 1.5% is one of the largest single quarter downgrades in history, and almost nobody covered it because the number looks boring, flat, stable, nothing to see. There's more going on underneath that revision than any housing headline published this month. And it doesn't just affect people buying or building homes. It affects the person replacing a roof, remodeling a kitchen, building a deck, staying in a house they already own. By the end of this video, you'll understand what broke in the cost to build and renovate in America, why it isn't coming back, and exactly where to find the data that tells you what it means for your specific situation, because the national headline doesn't. Building materials in the United States are 34% higher than December 2020. That's the baseline, before the current tariff round, before the mill closures accelerated, before diesel doubled. That 34% is the starting line, not the finish. On top of that baseline, kitchen cabinet tariffs doubled to 50% on January 1st, 2026. Steel and aluminum tariffs at 50%. Copper at 50%. Softwood lumber under a 10% blanket tariff plus Canadian duties, pushing combined rates to 45%. NAHB estimates tariffs alone add $7,500 to $10,900 to every new home built. And underneath all of those tariff numbers, the supply base that produces the lumber is being permanently destroyed while nobody's watching. Eastern U.S. hardwood sawmill production just hit a 65-year low, 4.12 billion board feet annualized, down 16.5% from 2024, down 45.7% from pre-COVID 2019, down 67% from the 1999 record. U.S. hardwood lumber production fell 29% between 2022 and 2025. 40,000 jobs gone. The Hardwood Federation confirmed at least one sawmill is closing every week. The NHLA confirmed over 4% of U.S. sawmills gone to closures and consolidation. More than 5 billion board feet of North American capacity has been permanently idled since 2023. Industry in Alabama, Mackey's Ferry in North Carolina, West Fraser in Georgia, Domtar in Arkansas, Harrigan Lumber in Alabama, Interfor in Louisiana. Named closures documented by Forest. And these are just the ones large enough to make the industry press. The small family mills closing across Appalachia and the rural South don't get headlines. They just stop operating. The equipment gets sold or scrapped. The workforce moves to other industries. The permits lapse. That capacity doesn't pause, it disappears. China killed the export market that kept many of these mills alive, banned American log imports in March 2025, imposed 125% retaliatory tariffs in April. Vietnamese exporters filled the gap immediately. Shipments to China surged from $6 million to $28 million per month by mid-2025. That market share relocated permanently. The revenue that kept marginal U.S. mills operating is gone, and it's not coming back with a trade negotiation.
Hey, real quick, if you don't mind me jumping in, if you want to learn how to take advantage and learn about real estate cycles and when they go up, when they go down, so you could do something ahead of time for it, put together 4 courses: the real estate cycles course, the bear market course, the home seller pro course, and a secret one that will blow your mind on how to buy properties when the time is right, how to sell them for a huge profit. Links down below. Now let's get back to the video.
Canadian softwood, 25 to 30% of US supply, is under 45% duties. Most Canadian mills are cash negative at prices below $500 per thousand board feet. Fast Markets projects North American capacity will drop 1.3 billion board feet in 2026. The last time capacity fell that fast was 2010, the bottom of the Great Financial Crisis. Ray White owns White Family Sawmill in Rowan County, Kentucky. He told Spectrum News, "Most of the time we've been losing money, and I can speak for the industry as a whole. Diesel costs are embedded in every step of the supply chain. Every log hauled from the forest, every board shipped from the mill, every delivery to the job site. Those costs didn't come down when the headlines moved on. They're still running. The railroad crosstie market just collapsed on top of all of it. The Union Pacific and Norfolk Southern merger created uncertainty. The Railway Tie Association projects over 1 million fewer crossties purchased in 2026, a sector-wide drop of at least 5%. Crossties have been the 3rd largest hardwood consumption sector since 2008. Southern sawmills that became heavily dependent on crosstie production just lost another revenue stream. I'm concerned about how many sawmill closures it will lead to. The price looks stable because the demand side is temporarily quiet. Starts are flat. Builders are pulling back. Nobody's panicking about lumber. That's exactly when supply destruction is hardest to see, and exactly when it matters most, because the capacity disappearing today is the capacity that won't exist when demand recovers. A curtailment is temporary. The mill idles and restarts. This isn't curtailment. This is dismantlement. Equipment sold, workers gone, permits lapsed. Building a new sawmill from scratch takes years to permit, finance, and commission. There is no switch. Your material costs move faster than your bids. The quote you gave 3 months ago doesn't reflect what you'll pay when you place the order. GAF, the largest residential roofing manufacturer in America, announced a 5 to 8% price increase effective April 15th. CertainTeed followed 3 days later with up to 8%. Cabinet costs jumped 15 to 25% on January 1st when the tariff doubled. NAHB's chief economist confirmed the sequence of who gets squeezed. Small contractor goes under first, then regional, then national. The nationals have long-term supply contracts. The small builder absorbs the hit in real time. If you haven't repriced your active pipeline, talk to your suppliers this week. If your colleagues haven't, send them this video. If you're seeing it on the ground right now, type it in the comments. Now, what this actually costs you, not abstractly, your project, kitchen remodel. The national average in 2026 is $35,000. Cabinets are 25 to 35% of that budget. 60% of kitchen cabinets sold in the United States are imported. The tariff on imported cabinets doubled from 25 to 50% on January 1st. That single change added $3,000 to $8,000 to the cabinet portion of most kitchen remodels overnight. The same cabinets, the same manufacturer, higher price because of a tariff that took effect between your quote and your signing. Appliances are up 16 to 18%. Copper and steel under 50% tariff. A kitchen gut renovation doesn't have one tariffed input. It has 5. Cabinets, appliances, copper, steel, lumber. Each increase looks manageable. Together, across the full scope of work, the total is thousands of dollars above where it was 6 months ago. Roof replacement, national average $9,000 to $18,000 for asphalt shingle. Both GAF and CertainTeed raised prices 5 to 8% effective April 15th. Roofing nails, flashing, and underlayment all contain steel or aluminum, all tariffed. Labor accounts for 60% of a roof replacement. Construction wages up 4.2% year over year, with a projected shortage of 499,000 workers in 2026, according to Deloitte. The quote that came in at 12,000 in February is 13 to 14,000 if you order materials after April 15th. Deck, 8,500 to 16,000 average, depending on material. A 300 square foot composite deck with railings, stairs, and lighting runs 18 to 20,000. Composite decking projected 5 to 7% increase through the year. Pressure-treated lumber affected by Canadian duties. The deck you priced last summer needs repricing before you sign. The pattern is identical across every project. Not one material got more expensive. Every material in the same project got more expensive simultaneously. More than 60% of builders are reporting higher costs directly attributable to tariffs. NAHB confirmed. Now, what does this mean for your property, whether you're building or not? If you own a home, your replacement cost went up. When it costs more to build new construction can't undercut the existing market. Your home's competitive position improves. The housing shortage sits at 3.8 million units. Center for American Progress projects 450,000 fewer homes built over the next 5 years from tariff-driven cost increases alone. Every mill closure on top of that makes the shortage worse. If you're buying, the shortage tightens. The pipeline of new inventory that was supposed to bring prices down is shrinking because builders can't make the numbers work at current costs. The cost floor for a new build keeps rising. Existing home prices follow. If you're renting, multifamily construction costs are up 30% in 5 years. Developers pass that to tenants. The rental supply that was supposed to loosen the market and bring rents down is building slower. Rents stabilize at a higher floor, not a lower one. Is this regional? Yes. The Sun Belt, where construction boomed during the pandemic, has the most exposure. Overbuilt inventory colliding with rising costs. Florida and Texas seeing starts fall hardest while costs rise. The Rust Belt, where construction never boomed, has less inventory risk, but the same material cost increases. Insurance. Your homeowner's policy is based on replacement cost, what it would cost to rebuild your home from the foundation. That number just went up. Building materials 34% above 2020, plus the current tariff round, plus labor up 0.2%. If you haven't updated your coverage and your replacement cost estimate is based on numbers from 2 or 3 years ago, you may be underinsured. The same construction cost crisis shutting down builders is the one that changes what your insurer owes if a fire, a flood, or a storm takes your house. Call your agent. Ask what your current replacement cost estimate is. Then ask what it would actually cost to rebuild at 2026 material and labor prices. If those numbers don't match, you have a gap. Property taxes. When existing home values rise because new construction can't compete on cost, assessed values follow. Higher assessment means a higher tax bill. The homeowner who saw their home value go up isn't just wealthier on paper. They're paying for that paper wealth every year in the assessment. Where to look for the real numbers? Because the national headline doesn't tell you what's happening in your market. Fast Markets tracks mill capacity and closures. When capacity loss accelerates beyond their 1.3 billion board foot projection, the supply destruction is worse than forecast. Gordian publishes quarterly construction cost updates broken down by material and by region through their RS Means database. Fast Markets tracks mill capacity and closures. When capacity loss accelerates beyond their 1.3 billion board foot projection, the supply destruction is worse than forecast. At the local level, building permit data published by your county. Your county's permit filings tell you whether new construction is happening in your specific market or stalling. That data is public. It's free. It's updated monthly. It's the closest thing to a real-time signal. Forest Economic Advisors revised their demand forecast between January and March from 8.6% growth to 1.5%. That revision tells you the housing recovery just got pushed back by a year. The mills closing today are closing into a longer trough than anyone projected. Now, What's downstream? Because the construction cost crisis doesn't end at construction, it cascades. Small builders go under first. That shrinks the contractor pool. Fewer builders means less competition, higher bids from the survivors. Insurance premiums adjust to the new replacement cost. Every policy in America is being recalculated against material prices that are 34% above 2020 and climbing. The same tariffs driving construction costs up are the ones driving your premium up, even if you never build anything. The homeowner in Florida, already dealing with the insurance crisis from hurricane exposure, is now absorbing the construction cost crisis on top of it. Two forces hitting the same premium. The affordability spiral tightens. 450,000 fewer homes built. That competition keeps prices elevated and keeps rents elevated. The housing shortage that caused the affordability crisis gets worse because the one solution, building more homes, just got priced beyond what most builders can deliver. And property tax assessments follow values up. The cost to build broke. The fracture runs through insurance, through taxes, through rents, through the contractor pool, through the affordability crisis that was already the worst in a generation. Every homeowner in America is downstream of this. The person who sees it in the data before they see it in their next quote, their next premium notice, or their next tax bill is the person who planned for it instead of absorbing it. The data is public. The tools are free. The revision already happened from 8.6 to 1.5, and almost nobody reported it. Now you know where to look.